Markets this morning are trading lower after finishing higher yesterday. The Dow, the S&P 500, and the Nasdaq all finishing up around session highs by the close in a technology-led reversal yesterday. Dow Industrials this morning down 71, S&P 500 down 7.75, and the Nasdaq lower by 24.25. But of course, we are kicking off the busiest week yet for first quarter earnings this morning, and we want to hear about the impact on earnings and what is expected to be a slower economy this year. Joining me right now is National Securities Corporation Chief Investment Strategist Art Hogan. Also joining the conversation all morning long this morning is Payne Capital Management President Ryan Payne and Forbes Media Chairman and author of Inflation, What It Is, Why It's Bad, and How to Fix It. Steve Forbes is here. Art, it's great to see you. Welcome back to the program. Thanks very much for weighing in this morning. We've got some big earnings on tap. Microsoft and Alphabet reporting after the close tonight. We've got Meta and Apple reporting later on in the week. What are you expecting from this big week from big tech?
Yeah, that's such a great question, Maria. And I think when you think about what this market's been focused on for the last couple of weeks, it really has all coalesced around how aggressive the Fed will have to be to fight inflation. And I think this week, being the busiest week of earnings in the season thus far, is going to really shift investors' focus to what we should be thinking about. And that's really corporate results and guidance for the second quarter and the second half. I'm guessing this actually proves a point at which we stop some of the selling pressure. Investors actually get to disseminate how much damage has been done, especially to the growth names and technology in general, and give investors a chance to say we've overdone it in several instances. You look at Google, which is going to report after the bell, and they're down some 20% from their all-time highs. Apple's off about 10%. The Meta platform obviously having its own issues, but clearly I think this is an opportunity 4 times a year for investors to shift their focus from the macro to the micro, and it's likely going to be a positive.
Yeah, so, I mean, I guess most important is the guidance that we're going to get, Art. I mean, we are seeing so many expectations that we're going to have a slowdown in the economy. We had Nancy Lazar on the program yesterday. She is expecting a global recession. She says we're already in it globally. So what do you expect from these companies, whether it's big tech or GM, GE, a lot of industrials as well reporting today in terms of their approach to the rest of the year?
Yeah, I would tell you this. I think that the corporate results are a lot better than the market has priced in thus far. And the reason I say that is if we look at what we've heard from the S&P 500 so far, and it's about 100 of the S&P 500 companies have reported, 77% of them have actually beat their earnings estimates and 75% have beat their revenue estimates. At the very same time, about 65% have raised their guidance for the rest of this year. So I think the market is actually doing one thing and corporate America is doing another. I think corporate America is in pretty good shape. A lot of companies that can actually do this are actually taking price and passing along higher cost. So not everyone is adversely affected by the near-term inflation that we're fighting. So I think this is a point in time where we say, okay, let's stop focusing on the parade of hawkish Fed speakers, and let's start focusing on real corporate results. At the very same time, we're going to get some pretty important economic data this week, too. So a lot of catalysts that sort of shift the narrative around a little bit. I think one of the more important things that's going to happen is when we get to the next Fed meeting, that instead of being concerned about what the Fed might do, we're going to actually see what the Fed will do. They'll likely raise by 50 basis points. They'll likely lay out the cadence for quantitative tightening and shrinking the balance sheet. And instead of anticipating worst case scenarios, investors will likely see what the path is going forward for monetary policy. So very much like the March 15th meeting, the market actually rallied about 10% after that meeting because the anticipation of monetary policy tightening, oftentimes is worse than the actual event. And I think the same thing will be true in the first week of May.
Yeah, I mean, it's interesting. A 50 basis point hike is not, troubling investors. Things are going to get more expensive on top of a slowing economy. But, Art, I got to get your take on the big story, and that is Twitter officially accepting Elon Musk's $44 billion cash deal to take over this company, take it private. The stock was up better than 5% yesterday, and now it is extending those gains up another 0.5%. What does this mean, in your view, for the company, Twitter users? Does this change the game in any framework from your standpoint?
Well, absolutely it makes a big difference, right? So companies that are private can operate a whole lot differently than companies that are public. I think early on, investors were skeptical that this would actually come to fruition. Remember back in August of 18, Elon Musk tweeted out that he was contemplating taking Tesla private at $420, and that never came to bear. So, there was some skepticism that A, he would actually go through this, and B, he would find the financing. And all that came together over the course of 2 weeks. So in a very rapid fashion, was able to put together a package of financing, pledged a lot of his own money against a lot of his own stock, and accomplished this. So I think investors were a little shocked that this is happening. And now what happens going forward? Obviously, Elon Musk would like to make some significant changes and likely improve the service and sort of dig into some of the algorithms that run things. But I think that this is going to be a net positive for Twitter, and I wouldn't be shocked whatsoever if he put this out to the public markets again, sometime in 2023.
Yeah, that's a great point, Art. Real quick before you go, having said all of that, it sounds like you're constructive on this market. You want to buy any dips here?
Well, I'd certainly do in technology that has earnings, right? So think about technology in two buckets. There's the fast revenue growers that are measured by a price to sales. They're still to be avoided. But I think in the stalwart names that actually have price to earnings that have been beaten up here, I think this is the opportunity to get back into those names because I think they're very durable cash flows and agnostic to economic activity.
Art, it's great to see you as always. Please come back soon. Love to talk with you. Thank you, sir. Art Hogan joining us this morning.